feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
Paul Tudor Jones just came out and basically said, this AI boom, it smells like 1999 all over again. And if you don't know what happened in 99, let me break it down for you. The internet was the future, just like AI is now. Stocks were going crazy. People were experiencing their stock accounts going up almost every single day. In fact, between October 99 and March of 2000, the market doubled. Guys, that is a matter of 6 months. Everyone in this world felt rich. And guess what? They weren't wrong. The internet was the future. And they're probably not wrong now. AI probably is the future today. But then it all came crashing down, and it crashed hard. Some people lost everything. And not because they were stupid, because they were blind. Blind to reality, blind to risk, and more than anything, they were high on FOMO, the fear of missing out. That's what is on my mind and what scares me right now. I look around. I see people piling into AI stocks blindly. Not because they understand them, not because they understand the future of them, not because they've done the research or know what the business is actually worth, but because they're afraid they're going to miss out on the next big thing. That's dangerous. Paul Tudor Jones isn't saying the crash is tomorrow. He is saying, yes, it might go higher, but that last run, that final sprint before it all comes apart, that's when people get trapped. And if you're new to this investing game, I want you to hear this. You are the most vulnerable right now. You're excited. You want to make money. You see other people making money, but you haven't felt the pain yet. The real pain, the kind that humbles you. Some of the analysts, after hearing Jones, are saying the crash is inevitable. And guys, that's a reality. Crash is always going to happen. We're not going to go the next 80 years of our market without a stock market crash. But right after that, they say you've got to stay in as long as possible. Milk the gains. Just make sure you get out before it turns. Let's slow down for a second. That sounds good in theory. So does communism. But let me ask you, how do you know when that moment is? As John Hussman so eloquently puts it, it's like being in a movie theater and looking at the fire exit and saying, it's okay, when a fire hits, I'll be the first one out the door. Because remember, there might be a false alarm. The market might fall suddenly, and all of a sudden people think this is the start of it, and it goes right back up again. So when exactly is the top? When does it stop going up and start crashing? Nobody has a fucking clue. What they're telling you is, yeah, this is going to blow up, but just ride down to the last second and then jump off. That's not a real strategy, guys. That's gambling. And here's the hard part. This kind of advice preys on people who are vulnerable, people who are new, people who think I can get in, make some money, and then get out right before it goes down. But I've lived through several crashes, 2000, 2008, COVID, and I can tell you, you have no idea when the top is in until you're very far down. That's how people lose half their portfolio very quickly. Guys, I was the same way in 2000. I was taking hints from people. I was sitting there saying, this is the future. You just got to bet on a bunch of great names and see it all go up. Now, a part of me also understood that when I buy a stock, I'm buying a piece of a business. But for some reason, I was like, yeah, but the internet, it's different. And I did have a justification. Tech stocks can make money faster, therefore they deserve a higher premium. That is a sound premise. That is something I believe today. But I exaggerated it too far. That's the problem. Now, I want to be very clear before we see comments in there saying, oh, Paul, you say the crash is coming tomorrow. That's not the case. I don't know when a crash is happening. I don't know if a crash is happening. And I'm not saying you're screwed. I actually believe the opposite. I believe there's a real way to do this. I believe you can protect yourself and still build long-term wealth. There is a path forward, and it has nothing to do with hype or guessing. And when you learn it, you're going to beat well over 90% of investors out there easily. And I'm going to show you how to do that in this video. Now, back to the crash in 2000. Here's what you need to understand. There was no trigger. There was no war. There was no Fed panic. There was no big bank collapse. It just turned. The last buyer of stocks was finally in. That could have been Stanley Druckenmiller. Go look at his history. He was a value investor true and true. And he uses different kinds of strategies to make money. He didn't have a down year in like 30 years. And he talks about how he finally gave in 2000 and said, I finally bought $6 billion worth of stocks. And when you ask him when he bought, he says, literally within hours of the peak. That is quite the anecdote. The last guy to enter, he was just like, finally, I was like, fine, I'll give it up. And 6 months later, that $6 billion became $3 billion. So 1 minute, people were quitting their jobs to trade .com stocks, and the next, 80% of the market was gone. It didn't start with a bang. It ended with a whisper, complacency, then capitulation fast. And by the way, guys, it didn't go like this. It went like this. Boom, 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 boom. It was oh, nope, we're getting back. Okay, we're getting back. And then after a while, it felt like, you know what? You can't buy stocks. That's what happened. We went from a peak time of saying buy internet stocks blindly to 2.5 years later, I was in orientation at a company that I'd been hired at. And one of the people in the orientation group said, well, you can't buy stocks and expect more than a 3% return a year over long periods of time. And I was like, oh my gosh, how much did this change? Unbelievable. People were saying we expected 20, 30, 40% a year just 2.5 years ago. Now people are saying 3% a year. People were paying absurd prices for companies that had no profit, no products, sometimes not even real business models. They weren't investing. They were believing. They were hoping. And when hope runs out, prices fall hard. In early 2000, Warren Buffett wrote a letter to his shareholders, and it captured the dot-com mania perfectly. He wrote, and I quote, "The line separating investment and speculation is never bright and clear. When speculation gets widespread and the public joins in, the consequences are usually tragic." He also says that every bubble starts in a good premise. Buy companies, buy the stock market, and then it slowly inches up into mania. He wasn't condemning speculation itself. He was worried and warning that it's contagious. People stop valuing businesses and start valuing what will go up next. Mark Twain has said many times, history doesn't repeat itself, but it rhymes. And he was right. And it's exactly what's happening now in some parts of the market. You need to understand that the story changes, but human behavior does not. Recognize the patterns and learn the history. The riskiest thing in the world is a belief that there's no risk. Now, I'm not making any predictions on when a crash will happen, and I can't tell you how bad it'll be. And I'm not here to tell you what to buy or sell. I will never do that. I'm here to teach a process and help you see where we are in the cycle potentially. But remember, the future is unknown. We have no idea what the future holds. We could be in the middle stages of a very, very long bull market. Hell, if you look at valuations, we're at levels we haven't seen since the Great Depression and over double the overvaluation metrics of 2000. Over double. But now we have companies, actually the Mag 7 are cheaper overall than a lot of the companies in 2000. So a lot of people are saying it's not apples to apples, and I get that. Back in 2000, an idea, no revenue, no profit, nothing, was still being valued at egregious amounts. Now we have companies that make real money. But I'm here to prepare you so that when the storm does hit, which it will, you're not running for cover. You're buying when it makes more sense. One of the best investors of all time, Howard Marks, said, "We never know where we're going, but we sure as hell ought to know where we are." That one line captures his entire philosophy. And it captures the philosophy of a lot of value investors. Because value investors sit there and say, I know where I'm at today. And if it doesn't make sense to me, I don't care if the short-term future is way higher. Marx does not claim to predict the future, quite the opposite. Instead, he insists that great investors must understand the present environment, what the crowd is doing, and how risk is being priced right now. What he means by that is, if people are paying more and more for more risk, that means they're not valuing how dangerous the risk can be. And one of the keys to your strategy is knowing where we are in the cycle. Not where the hype is, not what the headlines say, but where we actually are. Howard Marks is a master of this. Warren Buffett is as well. They're what we call contrarians, and I like to think I am as well. So what's a contrarian? It's someone who's willing to think differently when it matters most. It doesn't mean being a cynic or always going against the crowd just to be difficult. It means that when the crowd gets too excited, we get cautious. When the crowd gets too fearful, we start looking for opportunity. During 08 and 09, when everybody thought the world financial system was done, I was sitting there cheering for how great things were. That is what I mean. I sat there and said, this is absolutely incredible. This is a great time to buy. Why is everybody who sat there and said this before not doing the same thing? So now, with that same mindset in place, let's dig into the numbers. Let's look at valuations and let's see what the data is actually telling us. Because once you see that clearly, the rest of the picture starts to make a lot more sense. This is my stock market to GDP ratio. I made this one based on the S&P 500 going back 400 quarters, so 100 years. Now, what does this mean? Why is this often looked at, especially according to Warren Buffett, as the single most reliable metric at any given time? Well, if you think about it, guys, the US GDP is made up of a bunch of companies. So it makes sense that the companies within that GDP in the stock market would have some sort of relation to the entire US economy. If you told me tomorrow that US GDP doubled, I would sit there and argue that the values of these companies should probably about double. Now, JP Morgan published a chart showing the relationship between the S&P 500 PE, that's the price to earnings ratio, and the annualized return over the next 10 years. When the PE was 23, every case, no exceptions, the return for the next 10 years was between 2 and negative 2%. Right now, the S&P's current PE, around 23 to 25, mirrors the expensive levels of the late 1990s and 2021. Historically, such valuations have produced very low returns over the following decade, and it makes sense. If this phone is worth $1,000 and you pay $100 for it, you're gonna make a lot of money. If you pay $900 for it, you're gonna make a little bit of money. If you pay $1,500 for it, you're gonna lose money. Think of this phone as the US economy. The more you pay for it, the less your return will be. And in fact, look at the data up here. Going back almost 400 quarters, the average return, not including dividends, for the next 10 years is 6.4%. This is undervalued up to overvalued. And look what happens to the returns. If we're 30% or more undervalued, which means that the market should sell for 1,000, it's selling for 700 below. The return is 10.7 plus dividends. And as you get more expensive, what happens to this number? 10.7, 9.0, 2.1, negative 1.1, negative 1.8, negative 2.3. This is not coincidence. And with 400 samples here, it is not luck. It's pure logic. Now, what happens in between the 10 years, we don't know. Now, guys, I'm gonna tell you this. You're not gonna hear it anywhere else on YouTube. The media doesn't talk about it. Most creators don't even understand it. They're too busy chasing headlines, chasing hype, and trying to guess what stock's gonna explode next. But we're not here to play that game. We're here to think. We're here to teach that principle-driven investing idea to understand and to win in the long run. Valuations, that's the truth behind and underneath all of the noise. It's not sexy. It will never be sexy. It won't go viral. But let me ask you a question. What's more important to you? The ego of being involved in something sexy or your net worth? Because this is how real wealth is built and why most people never get there. In fact, there are studies that show that the market returns 9 to 10% on average. The average person over a 30 or 40 year period generates between 5 and 6%, even when invested. Why? Because they're buying at the wrong time, they're putting more money at the wrong time, and they're selling at the wrong time. The example I always give was in 2006, I sat down with two friends of mine who had just gotten married. I said, Paul, we want to sit there and talk about retirement. I said, great. Started going through the numbers and it looked good. And I said, guys, let me ask you a question. If the market fell in half tomorrow, and they were not buying individual stocks, if the market fell in half tomorrow, what would you do? And the wife looked at her husband, looked at me and said, we'd buy more, right? I said, they get it. This is perfect. Fast forward 2 years. The market starts to crash. I get a frantic email from the wife. Paul, what are you doing? And I said, well, we've talked about this. I'm buying more. You're actually buying more? Yeah, we talked about this. Oh, no, this is not the same thing. The world's going to shut down financial. I'm like, oh, okay. Well, the question I ask you is, what would cause markets to fall 50%? It's not just because people are like, we don't care. For the entire market to fall 50 or 55%, people have to have some excuse. And they sold. And for a short period of time, they looked right because the market went further south. But they didn't buy back up until 20 or 30% higher than the moment they sold. So if you're ready to stop being spoon-fed garbage and actually learn how to think like an investor, you're in the right place. And that's exactly why I teach on YouTube. Now, going back to the question everyone's been asking.
The idea is that, you're afraid to miss out, so you keep running with it, but you got to get out quick because eventually it's going to end poorly.
CNBC is asking it. Paul Tudor Jones is asking it. If you're being honest, you're probably asking it too. It feels like the top is coming. But as I said earlier in this video, the market doubled from October of 99 to March of 2000. So the logic becomes, let me ride the wave and jump out just in time. But here's the problem. That strategy never works. The data is clear. Investors who try to time the market always underperform. Dalbar, Vanguard, JP Morgan, they've all run the numbers. Retail investors consistently earn less than the market over time, that 5 or 6% I was telling you. Why? Because they get in too late and get out too early. Look at ARK Investments. When ARK was at $160 per share, everyone was buying. It fell to $30 or $40 per share. Guess what? It was still way up from its origination, but 70% of its investors had lost money because they bought at the wrong time. They were chasing that price going up. Good news is you're not helpless. You're not stuck. There's a better way that works for you. So here's what I'm going to show you next. A plan that works right now while the market is overvalued. A plan that helps you invest if we keep running higher, and a plan that keeps you ready if the crash finally hits. Listen, we're not predicting. We're preparing because we recognize the cycle. 3 guarantees in life: death, taxes, and cycles. Now, guys, the title of this video is there to sit there and show you guys the craziness out there. Now, I'm not condoning that title. I'm here to teach a process. And that title got you in. I'm so glad. If you've made it this far, it means it's probably making sense to you and you should keep on going. So now it's time to talk about what you can actually do. Because the goal here isn't to scare you. It's to give you a plan that works, a plan that builds confidence, a plan that you can stick to all throughout the noise. You don't need to time anything perfectly. There are multiple ways to win. You just need to pick what fits for you. So strategy number 1, dollar cost average into low cost ETFs and strike even hotter when it drops. Now this is talked about ad nauseum. I get that. Everybody talks about that. And we're going to go through 2 other strategies that have a little different variation, but this is the simplest and most effective strategy. Buy that low cost S&P 500. But if you have the balls to do it, when the market is below valuation, try to add a little bit more. If you do that, my back testing on this shows that you outperform by a little bit more. Let's break that down. An ETF, exchange traded fund, it's a basket of stocks. When you buy one share, you're getting a small piece of hundreds of companies. The popular ones are like VOO, SPY, QQQ, SCHD, these really popular big ones. They're low cost, they're diversified, and over time, they can compound. But the key is this: you have to keep investing regularly no matter what the market is doing, no matter what the noise and the news is doing. And when valuations drop, you put in more. You step in while everyone else is running. This is the S&P 500 going back to 1950. There are a few times here that we wish we would have bought all the time, right? And guess what? These are the times that it probably felt the scariest to buy. That's the key here. In order for things to be cheap, it's got to be scary. Remember what Warren Buffett says: be fearful when others are greedy and greedy when others are fearful. And Howard Marks even says, usually the best time to buy is when it's the hardest to buy. When the market crashes, you won't want to do it, but that's when it matters the most. So if and when the crash comes and you're staring at red screens and panic, I hope this video comes to your mind, because that's when some great opportunities show up. Number 2, tilt your exposure away from just big tech. Yeah, tech is awesome. Tech is great. You know, the NASDAQ's up 55% in the last few months. And maybe you're invested in the S&P 500, which gives you exposure to those big techs, but you want more upside, or you're worried about how top heavy it's become. Here's what you can do. Start tilting your portfolio into areas that are undervalued. Right now, the market's dominated by these mega cap tech stocks. Great companies, don't get me wrong, but they're priced, in my opinion, for perfection. That means less upside and more downside when the air comes out. So what can you add? Well, smaller cap stocks have been underperforming. Things like the Russell 2000. Smaller cap companies tend to rebound faster after downturns because everybody's so focused on the top heavy tech companies. Commodities, often ignored during tech manias, but can outperform when the cycle shifts. Personally, I have GDX and GDXJ. These are 2 gold mining ETFs. They're not buying gold. They buy the companies that make money off of gold, because I don't look at gold itself as an investment, but I look at buying the companies that make money off them as an investment. You can also look at sectors like energy, industrials, or even international, anything outside the overvalued echo chamber of big tech. To be clear, these other ones I'm talking about can still go down in a crash, but on the other side, they may rebound harder because they're starting from a lower valuation. This is how you position yourself for offense without chasing hype. And it doesn't mean stop buying the S&P 500. It just means, hey, if you want to add a few bucks to these to get a little less exposure, I don't blame you. It's an idea. Now, strategy number 3, for individual stock investors, we will never deviate from this. Buy great companies at great prices. And if the prices get even better, as long as the fundamentals are still the same, continue buying. This is where discipline really pays off for those of you who are buying individual stocks. But let me be blunt. In a crash, the hype stocks will get destroyed. We see it all the time. Recently, last week, the S&P 500 was down 1.3%. The NASDAQ 100 was down 3.6%. The flip side, when the S&P was up 20%, the NASDAQ was up 30 or 35%. Real businesses, they survive. They'll fall too, but they survive. And when they survive, they will then figure out a way to thrive. Now, here's what I need you to understand. The most important thing in buying an individual stock is knowing the difference between price and value. Price is what you pay, value is what you get. In a crash, prices fall fast, but the value of a great business doesn't disappear. In fact, that's when it becomes visible to those who are ready. We're going to preach on this forever in this channel. As value investors, we're trying to buy when price is less than value. So whether you're buying ETFs, reallocating sectors, or picking stocks, your edge is this: clarity, patience, discipline. You don't need to predict in the short run. You don't need to follow the crowd. In fact, quite the opposite. You just need to understand what you're buying and why you're buying it. Now, guys, principles are what keep me from getting sucked into the noise. Instead of panicking over every price move, as I said before, I stay focused on the only thing that matters: the difference between price and value. And this is why principle-driven investing matters so much. It keeps me from falling into the emotional traps that ruin most investors. When prices swing wildly, emotions tell you to chase when it's high and panic when it's low. But principles remind me that the market is just an auction and the price isn't the same as value. But sticking to my process, I avoid those knee-jerk reactions. I keep the questions as simple as possible. Is this company going to be around for a long period of time? Do I think they're going to make more money in the foreseeable 20, 30 years than today? So can I pay a reasonable price for it today that's below the value of those cash flows I'm going to receive? Every investment will end up being the present value of all the cash flows it gets. We don't know what those cash flows will be because it's the future and the future is unknown. But on a lot of companies, we can make reliable estimations and buy when there's ample margin of safety. That confidence and that discipline is what I need to sit still while others are freaking out. Principles aren't about making you emotionless. They're about giving you a framework so that your decisions are based on logic, not fear or greed. And that's how you stay focused on the only thing that matters in the long run: the gap between price and value. Now, there are 5 tenets that myself and the Everything Money community live by. They're called our principle-driven investing tenets. The first one is, we are investors, not speculators. Second one, every investment is the present value of all future cash flows. Third, if we don't understand it, we don't invest in it. 4, in the short run, the stock market's a voting machine. In the long run, it is a weighing machine. And the 5th and probably most important one, a great story can become a bad investment if you pay the wrong price. Now, guys, I don't expect you to memorize all these principles right away. That's why I put together a shortcut for you, a simple PDF that lays them out in plain English. No crazy jargon, just the rules, and why I like these to stay disciplined and avoid the emotional mistakes. This guide is your cheat sheet. You don't need to be a financial wizard, guys. You just need a framework. And that's exactly what this gives you. When prices are bouncing around and emotions are high, pull up the PDF, read through the principles, remind yourself why you're here, to focus on price versus value, not the daily noise. And remember, the noise will be bad. You will think that the world is coming to an end, to which I say, if the world's coming to an end, all the more reason why you should invest. Because it never does, and if it does come to an end, your money's not going to matter anyhow, whether it's in your bank account or in the stock market, so you might as well buy great companies cheap. Grab the PDF, click the link below, it'll be emailed you within 1 or 2 minutes, keep it handy, and use it as your anchor. I still do. It's simple, it works, and it'll help you make smarter, calmer investing decisions. So click it, download it, and start using it today. Now, this warning is hard to take in while the market's soaring. I get it. It can be difficult, and it's open to a lot of criticism. And you know what? I don't care that I'm early. Now, guys, in the short run, I do not mind looking wrong. It happens all the time. Because I'd rather be earlier to the truth if it saves one person from making disastrous mistakes. Now, if the market does blow off in a crash like 2000, like Paul Tudor Jones warns about, stocks will be a lot cheaper from a value standpoint. And that's exactly why I need you to learn this skill now. In this next video, I'm going to walk you through how we exactly and actually think about valuing stocks. That way, when prices swing and everyone is losing their mind, you'll be ready, you'll be calm, confident, and prepared to act. The link's right here on your screen. Don't miss it. This is how you get ready for your moment while everyone else is panicking. Thank you for your time.